When we talk about the cloud or this massive global surge in artificial intelligence, we tend to lean on these incredibly light, almost airy
Right,
metaphors.
like it's all just floating up there.
Exactly. You picture data just invisibly hanging in the sky, or algorithms magically thinking in the ether.
Yeah, it really creates this illusion of weightlessness. I mean, we use our phones or log into a web portal, and the actual processing feels completely detached from physical reality.
But then you look at the actual infrastructure required to make all this magic happen, and suddenly it's not light or airy at all. It is concrete.
Heavy concrete.
Concrete, steel, massive heavy water pipes, specialized plumbing, and high-voltage transmission lines. The cloud is, it's aggressively physical.
And that brings us to the core of our deep dive today. Welcome.
Mhm.
Our mission is to analyze a company that is currently trying to build the physical backbone of this AI boom.
And we are looking specifically at Applied Digital, right? Unpacking their fiscal Q3 2026 earnings call transcript and their financial results. Yeah, we are going to cut through the dense accounting and all that corporate jargon to really understand the massive shift happening right now in AI infrastructure, capital markets, and power generation.
It's a fascinating stack of sources to go through, too, because it sits right at this intersection of high-tech, heavy industry, and complex financial engineering. The documents really outline the blueprint for how the next decade of computing will physically exist.
It's going to be a fun one. But before we dive into the actual blueprints and balance sheets, we do have an important piece of housekeeping for you listening. All the information and analysis we discuss here is just to help everyone better understand the market and is not investment advice. Investing involves risks, so be sure to do your homework before entering the market or consult a professional financial advisor.
Absolutely. So, with that established, the central tension we are exploring today is just staggering at its scale.
Oh, it's massive.
Yeah, major tech companies, the hyperscalers, are currently pouring up to $700 billion into AI capital expenditures. But there is a massive physical bottleneck here.
The power grid.
Exactly. There simply isn't enough electricity on the grid or physical space equipped to handle the heat these machines generate to run all of it. So we are going to explore the specific mechanics of how Applied Digital is attempting to solve this.
Well, let's start by looking at the scoreboard for the quarter to understand the velocity of this expansion. The headline numbers here are pretty wild. Total revenues hit $126.6 million for the quarter.
Wow.
Yeah, that is a 139% increase year over year.
I mean, seeing triple-digit growth in a heavy infrastructure business is incredibly rare.
Right, because it's not software.
Exactly. Software companies can double their revenue by just distributing more code over the internet, but Applied Digital, they had to physically build and rent out specialized real estate to achieve that jump.
And the absolute engine of that growth was their HPC hosting segment. HPC standing for high performance computing. That segment alone generated $71 million.
That's a huge chunk of the total.
Yeah, and breaking that down, it's about $44.1 million in base rent, $18.9 million in tenant fit-out services, and $8.1 million in power pass-throughs. The major milestone driving all this is that their first 100-megawatt building at their Polaris Forge 1 campus in North Dakota is now fully online and operating.
Which is a massive proof of concept. I mean, they broke ground on that facility over 2 years ago, well before the current AI frenzy really peaked. And now they operate one of the few 100-megawatt direct-to-chip liquid-cooled data centers in the world.
Okay, so that phrase, direct-to-chip liquid cooling, it sounds intensely technical. It almost sounds like they're literally plumbing water pipes straight into server motherboards.
It kind of is.
Which, to anyone who has ever spilled coffee on a laptop, sounds like a complete short-circuit nightmare.
Yeah.
How does this actually work mechanically, and why is it suddenly a strict requirement for AI?
Well, it essentially is plumbing, like you said, but they use specialized dielectric fluids. So fluids that do not conduct electricity, which prevents those short circuits. Yeah, and the mechanism really comes down to the sheer physics of modern AI chips. In older data centers, keeping servers from overheating basically meant using massive air conditioners.
Right.
But next-generation AI GPUs run so intensely hot that pushing cold air over them is, well, it's like standing in front of a small desk fan on a 100-degree day. The air simply cannot absorb and carry the heat away fast enough. The chips would literally melt themselves.
Because air physically lacks the density to pull that much thermal energy away from the metal.
Precisely. So direct-to-chip liquid cooling means they run this specialized fluid directly over the microchips. Think about jumping into a cold swimming pool versus standing in front of a fan.
Oh, that makes sense. The pool cools you down instantly.
Yeah, the physical density of the liquid absorbs and removes the heat exponentially faster than moving air. But implementing this requires entirely different building designs. You need specialized leak prevention, massive cooling towers.
So you can't just slap this into an old building.
No, not at all. You cannot just retrofit a traditional air-cooled data center to do this efficiently. You basically have to pour new concrete and build it from the ground up.
It's like standard data centers are standard parking garages. But these new AI liquid-cooled centers are like Formula One pit stops. They need intense, hyper-specialized infrastructure.
That's a great way to put it.
But building massive specialized liquid cooling complexes across the frozen tundra of North Dakota, I mean, that requires an immense amount of capital.
Yeah.
And that leads to the catch in their financial report.
Right, the net loss.
Yeah. While revenues jumped 139%, they also reported a massive net loss of $100.9 million for the quarter. But looking at the sources, this isn't just operational cash going up in smoke, is it?
No, it's not. It's heavily driven by accounting mechanisms.
Okay, because the largest chunk is a $59.7 million non-cash write-down. The documents say this happened because they reclassified their cloud services business from held for sale back to a different accounting status. How does simply changing a label on an accounting sheet force a company to declare a nearly $60 million loss?
It comes down to how different types of assets are valued under accounting rules. So when a business segment is marked as held for sale, you value it based on what you believe a buyer in the open market will pay for it today. It's market value.
Sure.
However, when you pull it off the market and decide, hey, we're going to keep this, the rules force you to revalue it based on its long-term depreciating assets.
And in the cloud business, those assets are primarily computer hardware.
Yes, specifically older generations of GPUs. And computer hardware depreciates aggressively.
Very fast.
Yeah, so the moment they changed the accounting label, they had to recognize the depreciation of that hardware on their books, which instantly lowered its registered value by almost $60 million. So it hits the bottom line as a massive loss, but it is purely on paper. They didn't actually write a check for that amount.
That makes a lot more sense. And the second major component of the loss is $39.3 million in stock-based compensation, which they are rapidly expanding, managing a massive construction pipeline, and hiring thousands of skilled craft professionals to build these campuses in the middle of winter. So they use stock to attract and retain that talent.
Exactly, which hits the income statement as a loss, but again, it preserves their actual cash reserves.
And that preservation of cash is critical because constructing these specialized facilities requires immense upfront liquidity. So they are bleeding on paper to build the infrastructure of tomorrow, but they still need actual cash flow to pour that concrete today.
Right.
And ironically, the cash engine funding this hyper-futuristic AI infrastructure is actually their legacy business, crypto and Bitcoin mining data centers.
The contrast there is really striking. The data center hosting segment, the crypto side, is currently their highest return on assets. I mean, they generated $13.9 million in operating profit on about $120 million in deployed assets.
That's a great return.
It is, and they are running at absolute full capacity in North Dakota.
Well, the infrastructure required for Bitcoin mining is much simpler, right? It doesn't need that complex liquid cooling. It essentially just needs cheap power and basic airflow. So it generates this. I get separating the businesses, but they are giving up the absolute highest margin part of the AI boom. GPU rental rates are soaring right now. Aren't they essentially settling for the slow pennies of real estate while this new spinoff gets the fast dollars of software?
It's a fair question. And it is true that cloud computing offers massive short-term upside. But it also carries a radically different risk profile and requires a completely different capital structure. If we look at the mechanics of capital markets, keeping both businesses under one roof actually damages their ability to raise money.
Because investors get confused about what they're actually buying.
Exactly. Data centers are a heavy real estate play. You sign 15 to 30-year leases. The returns are slow, but they are highly predictable. Commercial real estate investors love that stability, right? But they absolutely hate the risk of buying computer hardware that becomes obsolete in 18 months.
That makes sense.
And on the flip side, tech investors want the explosive growth of cloud compute, but they don't want their capital tied up in pouring concrete foundations that take 2 decades to pay off.
So by jamming them together, Applied Digital was alienating both sets of investors.
Yeah. By spinning off Chronoscale, the cloud business can raise its own independent debt and equity to buy those expensive GPUs. It completely isolates the hardware depreciation risk from Applied Digital's core balance sheet, preventing massive equity dilution for the real estate investors.
Okay, I see the logic in isolating the risk.
Hmm.
But, even as a pure real estate landlord, you're still relying on those software renters to pay the rent. If their hardware ages and their business model fails, they default on the lease.
That's the primary risk of a landlord, yes.
We will actually get into exactly how Applied Digital protects themselves from that tenant default risk in a moment, because the financial engineering there is brilliant. But first, there is a much more physical problem. So they have the crypto cash flow, they've isolated the software risk, and they have the blueprints for these liquid-cooled facilities.
Right.
But none of that capital or real estate matters if you can't actually turn the servers on.
Which brings us to the absolute most critical constraint facing the entire global AI industry right now: power availability.
The scale of the power demand is difficult to overstate. On the call, management noted that hyperscaler capital expenditures have jumped from $400 billion to nearly $700 billion in an incredibly short window.
It's unprecedented.
The CEO pointed out that this demand is so voracious that you could utilize all the excess power currently sitting on the grid, and it still wouldn't come close to powering these new data centers.
Yeah, and to meet this, Applied Digital is actively marketing 4 major development sites. The centerpiece is Delta Forge 1.
Over.
This is a newly announced, massive 300-megawatt critical IT load campus spanning over 600 acres in the southern U.S., and it's expected to come online in mid-2027.
Now, the term critical IT load appears constantly in these sources. What does that actually measure?
So it is an important distinction in data center design. Critical IT load refers strictly to the electricity that is delivered directly to the computing equipment. So the servers and the storage themselves. It deliberately excludes the power required to run the cooling systems, the lighting, or the administrative buildings. So when they say it's a 300-megawatt critical IT load facility, the total power draw of that 600-acre campus is actually significantly higher once you factor in the massive cooling infrastructure required.
Wow. And finding that much power is practically impossible on the existing grid. So to solve this, Applied Digital is partnering with an independent power producer called Base Electron.
Right, in the Dakotas.
Yeah, they're building a 1.2 gigawatt natural gas power plant. Applied is taking a 10% equity stake in exchange for providing a limited credit guarantee to help get the project off the ground. But management emphasizes over and over that this power will be in front of the meter, meaning that the power goes to the public utility grid first, rather than behind the meter where the power plant wires directly into the data center.
Yes, that's a key detail.
But if I'm building a 300-megawatt campus, I would want that power completely behind the meter. I want it wired straight to my server so no one else can touch it. It's like building an incredible new fleet of electric bullet trains, but realizing halfway through that you also have to build the power plant to run them. Why go through the public grid?
Because operating entirely behind the meter creates massive community and regulatory friction.
How so?
Well, when a data center hoards a private power plant, local governments often push back. They view it as a resource drain that offers no utility to the surrounding area.
Oh, I see.
So by putting a massive 1.2 gigawatt plant in front of the meter, it feeds directly into the public grid, adding resilience and excess capacity to the entire region.
It fundamentally changes the relationship with the community. In the transcript, management noted that their massive, consistent power usage actually helps the local utility operate its baseload more efficiently, which spreads the fixed costs over a larger base. They estimate their operations have saved North Dakota ratepayers roughly $31 million.
And that symbiotic relationship is a brilliant strategic maneuver. It makes securing zoning approvals, negotiating with utilities, and navigating local regulations infinitely smoother when you can empirically prove that your presence is lowering the electricity bills for local residents.
But that raises another question for me. If securing power is the ultimate competitive advantage in AI right now, why partner with Base Electron? Why doesn't Applied Digital just own the 1.2 gigawatt power plant outright and capture the profits from the power generation too?
If we look closely at the operational dynamics, it comes back to that core concept of risk profiles again. A data center operates on a 15 to 30-year lease with an investment-grade tenant. That is highly predictable, guaranteed income. Operating a power plant, however, introduces severe commodity and operational risks.
Right, because natural gas prices fluctuate wildly, turbines break down, and, environmental regulations can shift overnight.
Precisely. By structuring it so that Base Electron remains an independent entity where Applied only holds a 10% stake, they secure the necessary power generation to support their campuses without carrying the immense liability of the energy commodity markets on their own balance sheet.
So they get the electricity without the downside risk of being a utility operator.
Exactly. They stay focused on what they do best.
Okay, so they secure the power, they mitigate the risk, and they design the cooling systems. But paying for all this requires billions of dollars. And that brings us to the final piece of the puzzle, the financial engineering.
Yes, this is where it gets really interesting.
They recently secured $2.15 billion in senior secured notes at a 6.75% interest rate to fund the Polaris Forge 2 campus. They also noted that the electrical substation construction remains the longest pole in the tent, meaning it is the single most time-consuming bottleneck that dictates the entire construction schedule.
Raising $2 billion is a massive feat on its own, but the truly impressive financial maneuver discussed on the call involves how they restructured their lease with CoreWeave.
CoreWeave being a major AI cloud provider and their primary tenant at Polaris Forge 1.
Right. Applied Digital restructured this lease using an SPV, or a special purpose vehicle, wholly owned by CoreWeave.
Let's crack open the mechanics of an SPV for a second. It essentially like a financial lockbox.
It is more than just a lockbox. It's a legally isolated vault with a dedicated pipeline straight to the bank. So CoreWeave places the lease agreement inside this newly created SPV. This legal structure ensures that the revenue meant to pay for the data center lease is completely isolated from any other operational risks or potential bankruptcies within CoreWeave's broader corporate structure.
Oh, okay.
Yeah, and they paired this isolation with a $50 million letter of credit and a corporate parent guarantee.
And that isolation is what triggered a massive credit rating upgrade. Because the cash flow is shielded, this specific lease structure received an investment-grade A3 credit rating, jumping up from CoreWeave's previous BB rating.
And that jump is the linchpin of their entire long-term financial strategy.
Right, but what does a credit rating upgrade from BB to A3 actually mean for the listener who isn't, a fixed-income bond trader?
Well, going from junk bond status to an A3 rating fundamentally alters the math of the company. It means they aren't relying on massive, high-interest 12% construction loans anymore. They can tap into institutional money.
Like pension funds and insurance companies.
Yes, at half the cost, which completely changes their margin structure. That is the exact mechanism they refer to as the tipping point.
The tipping point.
Yeah. Right now, while they are pouring concrete, their cost of capital is high through project finance loans. But once a building is finished and they have that incredibly reliable A3-rated tenant locked into an SPV, they transition to the next phase. They package these secure long-term leases into asset-backed securities, or ABS.
It operates basically just like refinancing an expensive short-term construction loan into a cheap 30-year fixed mortgage once the house is fully built and rented out.
That's the perfect analogy, yes. Transitioning to asset-backed securities allows them to drastically lower their interest expenses. As these massive campuses come online and they execute this refinancing strategy, their profit margins will expand exponentially.
It's a compounding effect.
Absolutely. This financial transition is how they plan to unlock massive shareholder value and hit their stated target of generating between $1 billion and $2 billion in net operating income within the next 5 years.
$1 to $2 billion in net operating income. The sheer scale of the capital moving through this space is just breathtaking. We have covered a tremendous amount of ground today, from the microscopic physics of heat transfer to the macroeconomic movements of the bond market. Let's pull all these threads together and provide a clear recap for you listening.
Sounds good. The analysis of Applied Digital really breaks down into 3 key pillars: the numbers, the strategy, and the future outlook.
Right. First, the numbers. Revenue is exploding, up 139%, entirely driven by their ability to bring high-performance liquid-cooled infrastructure online ahead of the competition. However, the massive upfront costs of building this physical infrastructure and restructuring their accounting classifications are currently resulting in significant net losses on paper.
Second, the strategy. They are highly disciplined in managing risk. They utilize their legacy crypto mining business as a steady cash generator, and they are actively spinning off their cloud software business into a separate company, Chronoscale.
CHRN.
Yeah. This isolates the risk of depreciating hardware and allows them to focus purely on being a high-grade real estate and infrastructure provider.
And finally, the future outlook and challenges. Power is the ultimate bottleneck for the global AI industry. Applied Digital is solving this by supporting grid-friendly partnerships like Base Electron to add immense power capacity to the public system, improving local grid resilience. Simultaneously, they're utilizing advanced financial engineering, like SPVs and asset-backed securities, to dramatically lower their debt costs and expand their profit margins over time.
It really is a meticulously designed approach to solving a very physical, complex problem. And examining all this source material leaves us with a compelling final thought to consider for you listening.
Oh, let's hear it.
We have spent this deep dive talking about 15 to 30-year guaranteed revenue streams, massive physical campuses spanning hundreds of acres, and deep symbiotic integration with public power grids. As artificial intelligence integrates into literally every facet of human life, from medical research to logistics to daily communication, are companies like Applied Digital shifting away from simply being tech real estate?
What do you mean?
Are they essentially becoming the foundational utility companies of the 21st century?
Wow, they are positioning themselves to be the water companies and the power grids of the AI age. It completely changes how you look at a concrete building in North Dakota. Well, thank you so much for joining us on this deep dive. We hope it helped you see the massive physical weight and the careful financial engineering behind the cloud just a little bit clearer. Until next time, keep exploring.